Well, hello, this is Dean Tinney. I'm coming to you from my fabulous studio here in Las Vegas. Today, we're going to be explicating a 65 practice final. We always on the playlist try and at least give you some narrative lectures. Here on the 65 is kind of baby 7, so you have quite a few investment-oriented narrative lectures on the various investment vehicles. And then on the regulatory side, you have one about investment advisors and investment advisor reps. And you have a second on the Uniform Securities Act. Both of those are target rich. And if the playlist, so 65 playlists, the other thing we like to put in the playlist is a explication of test specifications. We're pretty much done with that. We've got a little bit more to do. I'm going to try and close that, that gap on the 65 test specification shortly. You know, the 65 content and 66 content, both of them are NASA exams, and there's some shared content. And I did put the 14 questions that are on 66 test specifications into the playlist on the 65 because it's unethical business behavior, and that's testable on both exams. So don't be concerned if you see that and you say, well, it's a 66 and I'm a 65. Don't worry about it. And then today we like to provide at least one practice final. What I do is I collect debrief people from successful test takers. When I have enough to support a practice final, I, put it up here, and that's what we're doing today. Be careful. I get a little worried. We have, 3 practice exams on Series 7 playlist coming up on 4. We're working on 4 now. These aren't diagnostics, these finals. These are a way to share with you current test topics and give you some additional practice drilling and rehearsing on those test topics. So I get a little nervous when somebody's trying to use one of my explicated practice finals as like the equivalent of a Kaplan's Mastery or the equivalent of STC's Green Light, because that's not really what we're trying to do here. All right, well, let's get started. Okay, so here we go. So we got a Series 65 exam practice final. Again, what you can do is you can stop or pause and you can attempt it yourself. And then you can, re-hit the play button and see how you did. The other thing is, I don't know how long it will take us to get this through, but, if you need to, most people are wired for, 45 minutes, an hour of sustained concentration. So if need be, hit the pause button and come back to it. I'll be here waiting for you. This is very high probability. I can't imagine any draw on 65 in which you don't get asked about a qualified domestic relations order. Now, the key here is this domestic relations order from the court means that the distribution to the spouse is going to be non-taxable, right? So this is after a divorce, how we split this up. And, I have a lot of students who have practical experience with a QDRO. Make sure you got that. Make sure you got that. RMD, just to, a lot of times distractors are right answers, different things. RMD is required minimum distributions for the vast majority of retirement plans, except the Roth at 72. Consent to service, very testable. That allows the state administrator to receive legal documents on your behalf. I serve the state administrator, you're considered served. And ACATS is how we transfer. That's the automated customer account transfer system. All the following are true of 457 comp plans, except they are mostly offered by local and state governments. That is indeed true. And since they're municipal retirement plans, they are not covered under ERISA. ERISA, the Employee Retirement Security Act, covers private pension plans, not the state, not counties, not cities, not the policemen, not the firemen. So, it's non-qualified under ERISA. Now, the trick there is usually non-qualified in almost every circumstance means you're using after-tax money, but this is not true of a 457. Again, this is a very high probability. This comes from debrief. Funded with pre-tax salary deduction, yes. The investment grow tax deferred, yes. And then D is the, let me fire up my annotation tool. I think what I should probably do is, circle the right answer or something as we go along. Which of the following describes the relationship between systematic risk, the tendency of securities prices to move together, and expected return from the assets? So, one thing you can do on these kind of questions where you're maybe struggling is say, well, I know the dividend discount model isn't really about systematic risk. I know the dividend discount model is taking the distributions, the dividends, and discounting them and coming to a present value. So, you're not going to have to do that, but, process of elimination. You should know that B is the same thing, except that relates to a dividend and distribution stream, income stream, where I expect perhaps the dividend will be growing. And so I should be able to get rid of that. Well, both of those are discount cash flow models. And so that would leave us with the right answer of the capital asset pricing model. Now, we also have 50 practice questions based on analytical methods. This is the part of the test specifications called analytical methods, about 5 questions. And I think people, unnecessarily get worked up about this stuff. It's not as a big a deal as I think people make it out to be. Theory isn't true. Theory is just a way of explaining things. The more a theory can explain, the better that theory is. And so risk-averse investors can construct portfolios to maximize return at a given level of market risk. That's called modern portfolio theory. Dow theory is a technical theory based on confirmation of a trend, based on, past price performance and volume. And, we're hoping that the past price performance can predict the future. And that's about support and resistance and the industrials and transportations. Who cares? Odd lot trading theory says that odd lots, that's less than 100. The normal unit of delivery is 100 shares. So odd lot trading theory says if you can't afford to buy 100 shares, there's a reason. And perhaps that reason is you're not sophisticated, and we should do the opposite. And short interest theory is kind of counterintuitive. It says that short sellers represent future buyers. And so short interest theory says short sellers can accelerate bullish trends because as the market moves against them, they have to buy the cover. Sometimes that's known as a short squeeze. The answer here is C, as in Charlie. You're going to get tested primarily on negative correlation, but you should have expect a question on correlation. So securities that move in no discernible pattern relationship to each other are said to have no correlation, right? We can't figure out how they do. Positive correlation would be the one I always use. I've got to come up with a better one, but, Ford and GM, right? There's positive correlation. So, if I'm a modern portfolio theory practitioner and I'm looking at the portfolio, I'm trying to provide additional diversification. If I already have Ford in the portfolio and I put GM there, that's not going to do much in terms of modern portfolio theory. Now, I might, under some other investment style, I may be consciously deciding that I want to be exposed to the automobile industry and I'm purposely buying Ford and GM. But in terms of modern portfolio theory, I would be looking for something that has negative correlation with the Ford to add the additional diversification. There we go. That's the one that's more often testable, is this idea of negative correlation. Negative correlation means they go in opposite directions. And that would accomplish my purpose as a modern portfolio theory practitioner, is to put something in the portfolio that if, Ford goes up, or this goes down, vice versa, Ford goes down, this goes up. So maybe my premise is, people keep their cars longer. They're going to need to buy car parts, and maybe I buy a car part place. And by the way, I do the math. I just made that up. So to verify whether there is negative correlation, we do some math. The good news is we don't have to do the math. We just have to have general understanding. A measurement of a stock or fund's volatility as compared to the market as a whole. That's very much a test question. High probability. That's beta. Alpha is the excess return, and Sharpe is a way of risk measuring risk per unit. In other words, a higher Sharpe ratio would mean I got better performance with less risk than somebody has a lower Sharpe ratio. And standard deviation is the dispersion of the price within, the curve. So, but this one you should definitely know beta. Oh, there we go. That one's alpha. I'm gonna have to do a better job, I think, scrambling up the deck, I guess. All of the following are exempt from registration under 33 and the Uniform Securities Act, except. So one of these is going to have to be registered. So A, unregistered security compliant with Reg D. Yeah, Reg D is a private placement. That's a safe harbor under both. Safe harbor is the term, the legal term we use about, how to do things without getting in trouble. So if I'm, not just securities and legal in general, and as you can tell, this has a big legal flavor to your exam. But if I ask my attorney about anything, I say, is there any safe harbors available to me? Is there a way to do this, without getting in trouble? So that one, I don't have to register that with either 33 or Uniform Securities Act. U.S. government securities and the enterprises, Fannie Mae, Ginnie Mae, those are exempt under both 33 and the Uniform Securities Act. Municipal securities are exempt under both. Rule 147 is one of those tricky ones. That's a safe harbor available under 33. I don't have to register an intrastate offering of securities under 33, but I am going to have to register that through qualification under the Uniform Securities Act. So the answer to that one is D. An investment advisor representative, that will be you after you pass your exam, has calculated the value today of a future set of dividend or interest payments. The investment advisor representative has performed what type of analysis? Well, that's not fundamental analysis. That's fundamental analysis when we look at the economy, the industry, the financial statements. Technical analysis is when we look in supply and demand of the stock. More demand for the stock than supply, stock goes up. More supply than demand, stock goes down. We use charts to do that, a support and resistance line, and look for a breakthrough. Discounted cash flow, yeah. You only get like one insurance question or two, and futures needs analysis is associated with that insurance. If an investor uses an expected return of 10% on their initial investment to fund a college education, but the actual return is 8, the future value will be smaller than our math thought was going to be, right? So it's going to be smaller. We're going to have less money than we thought. Which of the following uses the present value of stock's future distributions for valuation? Now, sum of parts analysis is used to value a firm like Graham Holdings. Graham Holdings has lots of different subsidiaries. One of them, for example, is Kaplan. They have a couple auto dealerships and some restaurants. So you'd total up all the values of those subsidiaries separately to come up with a value. And that's more kind of fundamental analysis. Price to earnings ratio. We use that to make comparisons amongst companies. We take the price, we divide by the earnings and say, okay, well, if company A is trading at this PE ratio and company B is at this one, two schools of thought. One is I buy the undervalued, the one with the lower PE, and the other is I buy the higher PE because we can justify that based on a growing earnings momentum. Again, that's not this one. Ding, 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 ding. The dividend discount model. And then remember, there's two versions of this. There's one where we assume the dividend is constant, like we would in preferred stock. The dividend isn't going up. So you can't do dividend growth model with a preferred stock. But if you're buy a common stock and you're doing this analysis, you might make an assumption that the dividend will be rising. And then D is the market cap. Market cap. The way to get this right is long and low. Long and low. A lot of people who are practitioners of modern portfolio theory get upset a little bit with the teeter-totter. Because that teeter-totter that a lot of us saw makes it look like interest rates go down, bonds go up, or vice versa. That's a linear relationship. It really isn't. I wouldn't worry about it, but that non-linear relationship of that volatility, that sensitivity to interest rates is convexity, and that's what duration measures. But for test purposes, that doesn't really matter here as long as you don't freak out. So what you're going to do first is you're going to go for the longest maturity, and then you're going to go with the lowest coupon, the coupon acts as or I shouldn't say the coupon, dividends, any investment, an income stream, an investment with an income stream is going to be more stable in price than an investment without an income stream, because at some point somebody would buy it, to capture that income stream. So the way you attack this question is you go long, pick the longest maturity, and then the lowest coupon. Which of the following qualify? This is high probability on your exam for a tax sheltered annuity. Please note, this is not a tax deferred annuity. This is a tax sheltered annuity. And that means we're using pre-tax money. So it's not just the teachers, it's just not the nurses, it's everybody who is an employee, not the students. You got to be an employee of the educational establishment. Now, the other one that gets this is 501(c)s, charitable organizations. That's a high probability question on your exam. Which of the following is qualified tax-free withdrawal from a health savings account? Which of the following is a qualified tax-free withdrawal? So what they're asking here, or where I'm asking based on debrief, is which one of these is okay? A withdrawal used to pay for alcohol rehab, a withdrawal used to pay the premium on health insurance, a withdrawal to pay for travel to and from your doctor, a withdrawal to pay for cosmetic surgery. I should have put on this one. Let me fix this. I think I should have made this an accept. Looks like I got a little. What I'm getting at in this question is that the cosmetic surgery is not something that you can do. So, yeah, let me just. Right. And so that's what we're getting at here. Let me get back my annotation tool. I've got another one like this too. I don't know which one you're going to get, but you're going to get an HSA. Sorry. You're going to get an HSA question, right? A husband and wife change. Let me clear up the slide there. A husband and wife changed the form. This comes from debrief. As I mentioned, almost all these questions come from debrief. I'm not allowed to ask you like what was question 35, but I can ask is, hey, what do you think I should have done a better job presenting to you? You know, and you tell me what do you think I should do, and then I come up with a question trying to get these questions on target, so to speak. Anyways, a husband and wife changed the form of the ownership in their business from a partnership to an LLC. What could have been the motivating factor? Well, both an LLC and partnership have the flow through of the tax advantages. They wish to be able to retain earnings. Neither of them have retained earnings, so that could have been it. They wish to expand the number of owners. That doesn't sound like it. Yeah, the liability difference is what's the difference? The difference between an LLC and a partnership is a general partner has unlimited liabilities, and the managing member of an LLC does not. Access persons. It's surprising to me how many people see questions on access persons, more than one. And it seems like the study materials that people purchase don't really, draw this out in a way that makes people feel comfortable when they encountered it on their exam. So here, way I think I would attack is Sesame Street trick. One of these people is not like the other. So which one of these people is not like the other? Now, we want to make sure the access persons aren't shadowing, like perhaps one of the investment advisory client's trades, who is perhaps that investment advisory client might be a, officer, director, principal stockholder, for example, of a public company, and they're trading on material non-public information. And then our access person is shadowing their trades, things like that. And so officers of the investment advisor, yep. Directors of the investment advisor, yep. Partners of the investment advisor, yeah. D, yeah, that looks like the person least likely to be able to shadow trades or have access to client portfolios. This is just the person who's out soliciting on behalf of the firm. By the way, that's soliciting on behalf of the firm means that's what they're doing. That's their job. They have a 65, but I mean, they don't really manage portfolios. We have dedicated men and women whose job it is to solicit on behalf of the investment advisor. All the following are inputs. To calculate the Sharpe ratio, except. And again, the Sharpe ratio is comparing risk. I mean, so if I'm a portfolio manager and you have two portfolio managers, me and another manager, and you say, well, Dean, both performed. You both had the same performance, so it's a tie. And I said, well, maybe not. Have you done the Sharpe ratio on our portfolios? Have you seen how much risk I took in delivering that return to you? Because, excuse me, I'm going to kill my price. Maybe my Sharpe ratio is higher, which means I delivered that return to you with lower risk. So return the portfolio, absolutely. Risk-free rate of return, absolutely. Standard deviation, yeah. No, discounted cash flow doesn't have anything to do with that Sharpe ratio, right? That's a different thing. This comes from debrief. I think this is kind of a silly question, but who am I to question, NASA wanting to know that that copper is not a precious metal. Copper is actually, a lot of people refer to copper as Dr. Copper, because copper is actually a leading economic indicator because people use it in building and things like that. So, but that is not a precious metal. Now, the other question here is that we're going to use precious metals as a modern portfolio theory practitioner because we think that the precious metals may have a different correlation, negative correlation to financial assets. So, for example, if the market goes down, 20% today, we would assume that, precious metals would go up. A client receives a positive email from a client. He responds and he closed copies 3 other of his clients. Every once in a while, somebody sends something nice about you and you want to share it. An investment advisor is allowed to share communications amongst his clients. Absolutely not. The investment advisor representative has not violated the customer's confidentiality. Yes, you have. See, there we go. By the way, test taking trick here, even Dean, when I write these questions, fall praise this, the principle of mutual exclusion, right? Can't be B and C in the same universe. Either we have violated the confidentiality or we have not, right? And then here I kind of was having fun. I tried to get you confused about a de minimis. The de minimis is about number of clients in a state, not communications. Again, this comes from debrief. So this wouldn't have been my way to, test you on this. But, the capitalization of a corporation is its long-term debt and net worth, right? That's what that is. And so the capitalization of a company consists of the equity and the debt. The equity and long-term together is called total capitalization. So debt to equity means I have $1 in long-term debt for every dollar I have in equity. So A says equal debt to equity on the balance sheet. Now, you always want to read RTFA. You always want to read the full answer set to see if perhaps I don't have a better answer than that. To be honest with you, the reason I don't want to swing on A here is because I'm thinking, well, I don't know about equal debt because some of the debt on the balance sheet is current liabilities, and that's not part of this. So let me see if I can find a better answer. Equal long-term debt to equity on the balance sheet. That sounds even better. So good thing I didn't just swing right away, because that sounds a little tighter. So let's equal current liabilities to current assets. Nope. Equal fixed debt. Nope. So B. You're definitely very high probability. I can't imagine you're not going to get questions. And this is, again, debrief about an ETN, exchange traded note, and an exchange traded fund. An exchange traded note is an equity instrument, and an ETF. An ETF is debt. Nope. An ETF trades on the secondary market, and an ETN does not. Nope. They both can be traded. The ETN is a debt instrument. That is very much a test question. No, the ETNs or debt instruments. And so that means you have counterparty risk. You have the risk that the sponsor, usually a financial institution, won't pay what they promised to pay, which is, based on the whatever the linked it's linked to, whether it be an index, right? So, for example, it's the S&P 500 and that goes up 36%, and it was a $100,000 ETN. I have a risk you're not going to write me a check for $136,000. Which of the following exposes a customer to unlimited risk? Now, I don't put into the playlist. The options lectures. There are 3+ hours on basic options and your hedges. And I'm not sure if you want to do that for the 3, 4, 5 questions you're exposed to. I think that the most important thing on your exam is this answer set. Long call is a choice to buy the stock. Short call is an obligation to sell the stock. Long put is a choice to sell the stock. Short put is an obligation to buy. There's 2 types of contracts, calls and puts. You can either buy them or sell them. And if you agree to sell stock you don't own, that's going to expose you to unlimited risk. That's called a naked or uncovered call. And, as an investment advisor rep, you should probably know, what exposes customers. And I did say there's not options on there. I told you 65 is kind of the baby 7. So I'm not sure, what to tell you about that. If you want to invest the 3.5 hours for the, 4 max 5 questions, that's up to you. And like I say, you won't find the options lectures in the 65 playlist that you can find up separately. And if you want to, I would recommend you the first 3. Don't do the 4th because that's totally overkill. But the first 3 lectures and options are appropriate. All of all need to be renewed each year, except, boy, you need to know that the consent to service is a permanent part of your record. It's a permanent part of the record. All these other registrations have to be renewed by December 31st. Which of the following is a qualitative measure of a mutual fund success? So one of these things isn't math. One of these things is not math. Beta is math. Time-weighted weighted return is math. The tenure of the fund manager is not math. It's not quantitative. It's qualitative. Qualitative is the kind of, I would think of it as the opposite of quantitative. And, you can see why that would be important, because we need to know how accountable the manager is for whatever that performance record is. Long tenure means the performance record probably does indeed belong to that current fund manager. And so if I'm showing you past performance and I say, well, yeah, but look, that not all that past performance is the team that's there now, or is not. So you can see why that would be important. Which form of efficient markup hypothesis, this is testable, says that all technical data, fundamental data, and private information there's no way to beat the market. That's called a strong form, right? So now that doesn't mean we're not going to recommend something to you. Maybe we recommend if you believe in the strong form of efficient market hypothesis, being, by the way, hypothesis isn't true either. It's just a way of explaining things, right? And, if you're a strong believer in the strong market version of this, then maybe we buy you an index fund. A present value calculation was done to determine the future value. The return was less than expected. So the future value will be, if we got less than we expected, then we're going to have less than we anticipated, right? We're going to have less than we anticipated. Again, please note these present value, future value things on your exam aren't as mathematically oriented as I think a lot of candidates think. So you just want to get comfortable, with phraseology and question. Gamma Global Investment Advisors. That was my firm when I was a practitioner. Gamma Global Investment Advisor acquires another investment advisor. Which of the following is true? So my firm has made an acquisition. A, the clients have to honor the duration of their existing investment advisory contract assigned to Gamma Global Investment Advisory. And clients may give oral consent to the assignment of their investment advisory contract. I just call them, say, hey, is it okay? Is it cool? And there we go. Clients must give written consent of the assignment. That's one of the dangers in making an acquisition of an investment advisory contract, because those clients say, well, gee, Dean, we didn't hire Gamma Global, we hired whoever, right? Clients may give negative consent. Now, negative consent is a term that means no news is good news. I told you you're taking a legal test. So negative consent means I just send you a letter, and in the letter I say, if this is not okay, call me, right? So that's what negative consent. Which of the following mutual fund share classes offer a breakpoint? That would be the class A, right? Then there'd be a letter of intent, and there'd be 13 months, and you can backdate it for 90 days. All right, and then we better not, be careful. We better not do a breakpoint sale. Breakpoints are good, the quantity discount, but we better not do a breakpoint sale. That would be bad. That's why I'm trying to maximize my commission by avoiding the breakpoint. So that'd be the class A. And then remember, investment clubs can't pull purchases for purposes of meeting that breakpoint. What formula is used to find the present value of an investment by using the future value that is decreased at a compound rate of return? So, boy, just trying to find, confusing ways to kind of say the same thing over and over again. that's discounted cash flow, right? Which of the following is true of a qualified dividend? Now, the answer set here is a little different, but if you don't have a qualified dividend, that means the dividend you're receiving, portfolio income, that portfolio income from the dividend will be taxed at your ordinary income tax rates. But if you own the stock, common or preferred, typically 60, 90 days, who cares? That's a qualified dividend, then that'll be taxed at lower than your portfolio income, which is your ordinary income tax rate. So that's kind of what I'm trying to get at in this question. So it's taxed as the same interest income on a muni bond. No, muni bonds are completely tax-free. It's taxed at a lower rate than interest income on a corporate bond. Well, let's think about that. The interest I receive in my portfolio income on a corporate bond is the same as my ordinary income tax rate. And so indeed, kind of a convoluted way to say that, but that is indeed true. It's taxed at 50%. No, I'm hoping here that you fall prey to this idea that 50% of dividend paid from company A to company B is tax excludable. This isn't a question about the dividend exclusion ratio of 50%. It is a dividend received from stock held in a qualified retirement plan. No. Yeah, I like my distractors there. Distractors are wrong answers that sound good. Listen, I don't know of any draw, very high probability where you're not going to have to do this. Either senior to junior or junior to senior. So chapter 7 is, who cares, a complete liquidation of the company. So that's in bankruptcy. In bankruptcy, we have chapter 7, which is liquidation, chapter 11, which is reorganization. And so from senior to junior, it's going to be number 1. Then it's going to be number 4, unsecured bonds. Then it's going to be our preferred stockholders. And then it's going to be our common stockholders come last. And so, angels weep for you if you know something's on the 65 and you still miss it. I don't know about you, when I take a test, I like to get to the first question I know the right answer to. I say, all right, something on this exam I actually know. Here, I'm just asking you to do it the other way, right? So we go from junior to senior. I just put this in there when I hit duplicate slides. I'm not even sure I got the right answer available to us, but let's do it. So it'd be common stock, then preferred stock, and then unsecured bonds, and then secured bonds. So let's see, do I have an actual answer set there? I haven't fixed that answer set to provide us with the right answer. So let's fix the answer set. And we just said it's going to be, we'll make it this one. So this will be 2. We're going common stock, preferred stock. And then we got unsecured bonds, which is, and then secured bonds. Okay, so now we have the answer available to us, which is answer B. Which of the following is not a fee that is paid? I probably, this one I want to clean up too. I appreciate your patience. I'm trying to, get the wording as close as I can. So that's why I've been sitting on this. By the way, I get these exams done, these practice exams, and I use them in tutoring. I use them, I field test them, so to speak. And then I, put them in there. And even at the last minute, when I'm putting it on the channel, I notice there's improvements that can be made. So I appreciate your patience. Anyways, this comes from Debrief, no surprise. And, the 12B1 fee is a promotional expense. So it's to pay for promotional expenses. So advertising, yes. Sales literature, yeah. And there might be a trailer paid to associated persons. It's not used to pay the investment management fee. It's not used to pay the investment management fee. So the answer to this one is D. Boom, not used for that. Again, very much test question. The following maximum, I can charge up to 25%. That's testable and still refer to myself as a no load fund. So the answer is A. Now 3/4 of 1% is going to be my max. So 1/4, 1%. I can still refer to myself as a no load. I go past that, I can't refer to myself as a no load, and then that 0.75 would be the max. A customer purchases, this is very high probability. I can't tell you how many people miss this question on a simple kind of a thing. So, a customer purchases a $100,000 S&P index annuity. This is not a security because there's no way you can lose money. And that's why insurance agents can sell this without a securities registration, because it's not a security. Securities have profits and losses, and this doesn't. So a 60% participation rate means that the index, whatever the index does, they're going to pay you up to 60% of that. And the cap means, but they will not pay you any more than 5%. So the S&P grew 11%. So we take 11% times 0.60. Well, you would find out that that's going to be 106,666, and that's more than the 5%. So I would just say, okay, well, it's going to be $11,000, and I'm going to times that by 0.60, and there's a cap at 5, so it's 105 in that first year. The next year it fell by 11%, and there's no negative reset. That's what I'm trying to get at, and that's what you need to make sure you got when you go to take the test. There's no negative reset, meaning this thing doesn't go backwards. It just goes forwards, right? So then next time period, we start over again. Don't ever on the take that cannot be determined. That's just not the right answer ever. Which of the following would qualify for soft dollar compensation paid by the broker dealer to the investment advisor? Yeah, you're not allowed. This is a question. Which of the following would qualify? You should know that you can't pay for travel, furniture, and rent. So a broker dealer can pay for seminar registration fees for the investment advisor as part of soft dollar compensation to the investment advisor for referring or directing transactions to that broker dealer. Definitely gonna get a soft dollar question or two. Broker dealers can't pay investment advisors travel costs, their furniture, or rent. Benchmark for a large cap fund. The ones they like are this one and the Russell 2000. So the Wilshire 5000 would be the total stock market, All the following are true of a broker dealer acting as a third party solicitor. So federally covered investment advisors can hire broker dealers to raise money for them. So if I'm a federally covered investment advisor and I'm going to hire Goldman Sachs to raise money or find me partners or find me investment advisory clients, the broker dealer, Goldman Sachs, doesn't have to register as an investment advisor to be fundraising for a federally covered investment advisor. My firm, that's what my broker dealer did. My broker dealer was a third party solicitor. So my broker dealer doesn't have to register as an investment advisor to do this. My associated persons of my broker dealer, my 7s and 63s, they don't need to register as investment advisor representatives. Their 7s and 63s are fine to be using or raising funds to fundraising for federally covered investment advisor. The broker dealer only needs to deliver its brochure. No. Very testable. I got to have 2 brochures, one that discloses to you that I am a third party solicitor, that I'm not affiliated with the federally covered investment advisors, but rather they have paid me to go find them clients, which means it's unlikely I'm not going to say wonderful things about them. And then a separate brochure that tells them about the investment advisory firm. So remember, this is an accept question. So all the following are part of the definition of an investment advisor except. Remember, this is the ABC test. ABC. Do you give investment advice? Do you hold yourself out as giving business and the business of giving investment advice? And do you want compensation? So remember, this is an accept question again. In fact, A, B, C. I think that's kind of a simple definition, but I can't tell you how many times on debrief people tell me that was very helpful to them in getting some questions correct. Under the Uniform Securities Act, an agent may request a review of the state administrator within how many days? I hope in these explications you have a stack of 3x5 or 4x6 cards, or maybe you have a different screen with Quizlet opened up or a notepad so you can take some notes. All the following natural persons. Now, I spend more time on this perhaps than others, but again, on this legal test you're taking, your firm is an unnatural person. Unnatural person legally is somebody who's not a living, breathing human being. A natural person is a living, breathing human being. 65s are natural persons. They're living, breathing human beings and must be, right? So all the following natural persons are investment advisors except, so again, the Sesame Street here, right? I think A needs to be an investment advisor rep. B needs to be an investment advisor rep. C, I don't think your receptionist, he doesn't need to be a, 65 to answer the phones. Net worth for a registered investment advisor with custody, 35 grand. Again, you're going to have to do this at least once. This is what we call the teeter totter, right? And here they tell me that the nominal yield is 7%. And they tell me that the yield to maturity is 5%. And so then what I got to be able to do is figure that out. Now, again, this isn't a lecture. I would refer you to my lecture. It's called Forward Bond, Not James Bond. Forward Bond, Not James Bond. And, you get a whole hour of this kind of stuff. And then the whole point, by the way, of buying the bond at a premium is we should understand as an investment advisor representative that we're probably not going to get yield to maturity. We're probably going to get yield to call. An investor pursuing an aggressive investment strategy, which of the following mutual funds is most suitable? So if you're aggressive, volatility is not bad, but, we might need to be, be aggressive and have more volatility. Get us where we need to go financially, our financial destination. And so if we're aggressive, we'll go for a fund with a higher beta. Or that 1.5 means 1.5% more volatile than the market up or down. Now, A is probably an index fund. That would be one as well, right? The S&P index fund. If an issuer will be registered in their security with the SEC and a state or states, what method would be used? And that would be coordination, right? Coordination is when we're doing multiple registrations. If we're only doing one registration in a particular state, that would be qualification. And if it's federally covered, perhaps we can just do a notification. Which of the following must an investment advisor consider when placing a municipal bond into a client's portfolio? You're definitely going to get a muni bond question or two. And this one is all of them. I need to know your tax bracket. Reciprocity doesn't apply state to state. So I need to make sure I know where you're a resident of what state. Which form of the market hypothesis says that all technical data and fundamental data is shared by all. And so the only way to beat the market is with private information. That would be semi-strong, right? Meaning there's, there are exceptions to this hypothesis. This is make sure you can contrast a Coverdale and an ESA. Very testable to be able to contrast a Coverdale and a 529, excuse me. So make sure you can do that. This is one of the distinctions here. It's means tested. The max is $2,000, and I would refer you to the 529. Make sure you can compare those. Your customer has a bond with 7. The CPI was 4. Constant dollars are dollars measured for inflation. So you're going to take the 7 minus the 4, and we got a 3% positive return after inflation. And that's the point, right? We want to have more purchasing power in the future than we have presently. Small cap stock is going to be Russell 2000. Those are the ones that show up. There's others, but I'm just trying to help you focus your efforts on what you can expect on your exam. All the following are true here again is this 457. What we're getting at again is that except it's a type of non-qualified plan. That's true. It's the one time it's a non-qualified, meaning it's still pre-tax, but again, it's not qualified under the Department of Labor or ERISA because again, it's mainly for municipal employees. It's a type of deferred comp. It is, but it's pre-tax deferred comp, which makes it different. It's typically offered to government employees. Yes. And that's why, since it's government employees, it's not subject to ERISA. I've got 2 versions of this just because it keeps coming back on debrief. An investment advisor representative in a customer portfolio goes long the August soybean futures at 450. So there's a couple reasons I could be doing this. One, I could simply be speculating on soybeans. And that'd be one reason to do this. The other reason I could be doing this is to hedge. Perhaps I use soybeans. Maybe I make soy milk or soy sauce or tofu. And I'm afraid that the price of soybeans are going to be higher in the future. And so I'm going to do in the futures market today what I'm going to do in the cash market later on. And so what I'm going to do later on is buy soybeans. So I'm going to go along the futures contract. And then what I'm hoping is if the price of soybeans go up in the cash market, when I buy those soybeans for my soy milk or soy sauce or my tofu, that what I made in this futures position will offset that. So I might be speculating or hedging. Now, I've had people ask me about making a lecture on futures. And on the third quarter update of the channel, I said I would be willing to do that, but there's only 1 or 2 questions. I'm not sure it's worth it. And it's certainly not worth a 30-minute lecture. But what I thought I might do, and in your comments, you can put that in the comment box. What I thought I might do is a series 3. That's commodity. That's guy who really have to do this. Maybe I'll do a 30-minute intro to that would include everything that would, you need to be held accountable for. So I would say, series 3, and then in parentheses, which I typically do, 65, 66 is 2. Anyways, it looks like this was a successful speculation on our part, or a hedge, depending on what we were doing. By the way, futures contracts too, remember, are better than forwards because they're exchange regulated. So you don't have to worry about somebody's going to, give you the money, right? So anyways, if we went long at 450 and we sold this thing at 5, it looks like we made 50 cents. And we made 50 cents on 5,000 bushels. And so I'm terrible at arithmetic, so I'm going to get my calculator here. 50 cents times 5,000 bushels. Looks like we made 2,500 bucks. All the following are persons except. All the following are not persons. Now remember, you're taking a legal exam. So we're saying only one of these persons in this question can be held legally accountable under the Uniform Securities Act. By the way, it's not just the Uniform Securities Act, it's law in general. Minors are not considered persons. Deceased individuals are not considered persons. Persons declared mentally incompetent. Oh yeah, you can be held legally accountable, most certainly. Release 1092 expanded the definition of investment advisor to include all the following, except, these were people who said, I don't know if I'm if it's a financial planner, this regulatory framework is for me. And the SEC said, yes. Pension consultants, yes. Agents of professional athletes and entertainers who provide money management, yes. So broker dealers, that's always been, broker dealers are the way they've always been. So the wrap account is not part of this interpretive release. Both investment advisors and investment advisor representatives may meet the de minimis to register in a particular state. Which of the following is true of the de minimis exemptions? A, no more than one office or place of business in the state, and 6 or fewer individual retail clients in the state. Now, remember, it's no office. When you have an office, you're going to have to get registered. No office in the state, and fewer than 6 individual clients in that state. That sounds pretty good. No office in the state and all retail clients are snowbirds. Well, that's not the de minimis. That's just a different thing. Office or place in the business state, but all clients are institutional now. It looks like B is our best answer there. Health savings accounts. We've talked about this. I have a couple here. It looks like I need to fix that. That shouldn't say HAAS. That should say HSA. So we're looking for something that's false, something that isn't an advantage. Funding it with pre-tax and money grows tax-free, that is an advantage. That is bueno. That's good. No deadline for spending accumulated money. That's a good thing, and that's true. Money can be withdrawn for tax-free for qualified medical expenses. That's a good thing. So D, have to be used with eligible health insurance plans, many with high deductibles. That's not an advantage. That's kind of goes with the territory. But D is not an advantage. Let me get my. If an investment advisor must register with the state if its AUM is, now again, be careful. I didn't say when you get kicked back to the state, right? If you're below 100 million, you belong to the state. You belong to the state. 90 to 110, you belong to either. Over 110, federal. Below 90 is a federal guy who gets kicked back to the state. So the best answer here is A. If an investment advisor fails to pay renewal fees to the state, which of the following is true? I don't know why people constantly send me emails and say, is it January 1st? No, it's December 1st. I don't know what the challenge is on that. It's December 31st. I think people overthink this thing. It's your registration expires on December 31st. That should be an aim and shoot point and click question. So, if you got your flashcards out, that'd be the time to, make that flashcard. Without custody, that's 10. An investment advisor representative is considering a taxable bond with a coupon of 7. So you're always going to get the tax bracket. Always going to get the tax bracket. And you're either going to get the taxable yield, or the tax-free yield. So here we're giving you the taxable yield. And so when you get the taxable yield, what you're going to do is you're going to multiply. You're going to multiply by 100% minus the tax bracket. The tax bracket is always given. So, and when we do that, that will give us the tax-free equivalent. I say, listen, in your tax bracket, getting 7, you don't get to take all of that home, right? The federal government taxes are the price you pay for civilization. So I'm going to take 7 times 0.65, and we find out that's 4.55. So in your bracket, getting 7 is the equivalent of that tax-free. So that's something I probably should know before I go to put that in your portfolio. Now, remember, the other version of this would be, I always give you the tax bracket, but I give you the muni bond, and you got to figure it out. I wish there were more math on 65 rather than less. And the reason is there's no interpretation of a math question. You simply get it right or you don't, right? Which of the following is used to measure inflation? Very much a test question. The Consumer Price Index. Remember, we talked about constant dollars. That also will be used to adjust the principal on a TIP, a Treasury inflation protected security. So, if CPI, I last figured, let's call it 6, is pretty close to 6%. If I have a TIP, the government now, instead of owes me 1,000, adjusts it and says, Dean, 6% on par is 60. Semi-annually will adjust it. So 1,030 is what we owe you now. Next period, 3% on 1,030. Broker dealers make money from all the following except commissions on issuer, non-issuer securities transaction. Yes. Markups. Yep. Markdowns. Yep. Not fees. We don't make money from fees. Fees are what investment advisors make. So if a broker dealer wants to charge fees, they're going to have to set up an affiliated investment advisory service. All the following are exempt securities under the Uniform Securities Act, except U.S. government agencies, yes. Municipalities, yes. Canadian, I say over and over again, Canada is just like the U.S. on the Uniform Securities Act. What I mean by that is British Columbia, a province in Canada, is no different than the state of Nevada, where I'm coming to you from, in terms of the Uniform Securities Act. And Vancouver, a city in British Columbia, on the Uniform Securities Act in your exam is no different than Las Vegas, Nevada, where I'm coming from, right? So they're considered, to be the same kind of a regulatory framework. Please note, it's called the North American Securities Administrator Association. So those 12 provinces in Canada are the equivalent of states in the U.S. as it relates to the Uniform Securities Act, and the registration of their securities, they're exempt. Now, the Canada is the only country that's true of. If this just said Mexico, D would be correct, but it says Mexico and its provinces. No. Baja California, a province of Mexico, is not the equivalent of British Columbia. And Ensenada, where I hang out a lot, a city in Baja, that is not the equivalent of either Las Vegas or Vancouver. So the provinces are not exempt. Mexico, with the Republic of Mexico, is because we have diplomatic relations. The easily accessible record keeping for an investment advisor is 5 years with 2 years at the principal office. C. An investment advisor rep is considering purchasing a municipal bond. So here we go. We're always going to get the tax bracket in either taxable or tax-free. If it's tax-free, we're going to divide. Taxable, we multiply. So we're going to take the 3% tax-free, and we're going to divide by 100% minus the tax bracket, which in this case, I'll just get a different color here, is 0.62. And we take 3 and we divide by 0.62, and that's 4.83. And, rounding won't cause us to miss any questions. So In your tax bracket, if I want to put this in your portfolio, getting 3 in your tax bracket is the equivalent of getting 4.8. That's something to know before I put it in your portfolio. Which of the following is true of an access person? The access person must file quarterly transaction reports with the investment advisor's chief compliance officer. That's exactly correct. The access person must send duplicate confirms and statements. No. The access person cannot have accounts with a broker dealer. No, no, it's A. It's A. That's a good, I sometimes talk about what I call poor man's flashcards. Where poor man's flashcard is where you just turn a question into a flashcard by getting rid of the wrong answers and then, reading that. I've had several requests for me to, make these decks available. I don't have a website. I just have a YouTube channel. So maybe at some point I'll, set up a website, and I know for some nominal fee, you can buy the deck or buy the rationales for all the questions. Which of the following are true of universal life? They have flexible premiums. Yep. Can accumulate cash value. Yep. It's considered an investment vehicle as well as an insurance vehicle. And on this exam, you're never supposed to sell insurance as an investment. Insurance is insurance. So hopefully we'll have enough cash buildup in a separate account, a sub account, a mutual fund, that we will no longer have to pay for insurance. But this is insurance. And because of the flexible premiums, if you miss payments, we're going to take that premium out of that sub account. And, we keep dipping into there. At some point, there may not be enough money, and then this thing could lapse. So the answer here is C. Which of the following describes the personnel? That's ADV Part 2B. Right. Remember, 2A is the one that talks about the firm. Broker dealers must register all the following except. Broker dealers must register with all the following except. Yeah. Right. Broker dealers don't have to register if they have no office and no retail clients. Office, you have an office in the state to bring. By the way, the trick here is it doesn't matter what kind of clientele you have. You have an office in the state, you need to register in the state. Again, if I'm short the stock, I'm afraid it's going to go up. And so what would be nice is to have the choice to buy back the borrowed stock at a set price. That's kind of a cool thing to be able to do. Again, I've told you, I'm not quite sure how much you want to spend on the options, but this is a choice to buy back the stock. And that would change the position from unlimited risk to limited risk. I'll leave it to you to decide. As I said, you've seen this answer set again. The most important thing if you plan on getting these right is to know that answer set. There are 2 types of contracts, calls and puts. You can either buy them or sell them. So that means we have 4 basic option positions, right? This is called a hedge, by the way. I would definitely know the hedge. The hedge is always, hedge means protection. And so you get a 50-50. I'll just give you a free kind of thing here. Protection always means you're going to buy the option, go long the option. So once they say protection, it's either going to be a long call or a long put. You get a 50-50. And you're always interested in the offset, meaning if you sold it, you want to buy it. If they say income, so protection means buy the option. If they say income, that means it's going to be one of these. Let me get a different color. It means you're going to sell the option. So it's going to be one of these if you're trying to get income. You're bring in the premium. I've got 2 versions of this. Now, I'm not the one who comes up with the mother and the daughter. This is based on debrief. So a mother buys 100 shares at, let's see, I think my screen sharing thing is covering up. I think that says 3,000. She dies. So boy, when you're doing your test, be careful about whether somebody died or were they gifted. You can counter both. So she's died. At the time of her death, the market value of the 100 shares was 5,000. The daughter inherits and sells several years later at 9. The daughter's cost base is 5,000. There's a step up in the basis. So be careful. It's different whether she dies or she gifts. I have the exact opposite of this question coming up, where the mom doesn't die. She actually gives the securities to her daughter as a gift, and that's a different answer. A broker-dealer must register with the state in which of the following circumstances? No office of the state only calls on issuers. Issuers are capable of protecting their own assets, their own interests. No office of the state calls on other broker-dealers. Nope. There's no de minimis There is no de minimis for a broker-dealer. A broker-dealer has one retail customer in the state. The broker-dealer needs to register. So make sure you got that. One retail customer triggers registration of the broker-dealer in the state. Federally covered securities include all the following: New York, NASDAQ, mutual funds. Yep. The one that's high risk is knowing the mutual fund is federally covered. A non-NASDAQ OTC stock is like bulletin board, pink sheets, that kind of stuff. For which of the following would a notice be filing most be appropriate? That again shows up a lot. That's the mutual fund, or that's the A, B, and D are not federally covered securities. C is. Which of the following are not sales? Now, on this multiple, this is the first one I think we've encountered. No, I have the one with the liquidation priority. You're going to get 2, 3, max 4 multiples of multiples. And all the providers, including yours truly, we go overkill on multiples because we just love multiples as test writers because it allows us to test you on 4 of a thing. And it means we can, stuff a lot more content into a question. But on your actual exam, you're only going to get, 3 or 4 of these. Anyways, here's one. Gift of non-assessable stock is not a sale. It's not subject to the jurisdiction of the Uniform Securities Act. Stock dividend or stock split with no payment is not a sale under the Uniform Securities Act. Liquidation of securities that were pledged in a bona fide loan. Bona fide is Latin for good faith. If I'm a lender and you pledge securities to me and you don't fulfill your responsibilities and I sell those securities to pay off the loan, I have no worries of running afoul of the Uniform Securities Act. Securities issued from an approved merger or business reorganization. I'm Disney and I've acquired Fox. And so as part of that transaction, I'm issuing Disney stock. The answer is 1, 2, 3, and 4. GDP can best be described as the total goods and services an economy produces. Listen, I have 2 very spot on economic lectures for you as a 65. One is on economics called Money is a Giant Floating Crap Game, which is what Lord John Maynard Keynes says. And you can find that in your 65 playlist. And that's a narrative lecture on economics. It's spot on, gives you everything you need for your exam. Now, the other thing I have there available for you in your 65 playlist is my explication of this function of the exam itself, where I just go through NASA's test specifications and literally tell you what the test content. So there'd be no excuse for a subscriber of Dean's channel, 65, not to be prepared totally for economics because it's all there for you. It's all there for you. Administrator has jurisdiction over all the following offers except. So an offer originated in the administrator state. Now, I suggest that to keep this in your own mind straight, just substitute your state. Say Nevada or whatever it is, originated in Nevada, directed into Nevada, accepted in Nevada. Yep. Not where the check was drawn. So, if I tell my bank in North Dakota that I've accepted an offer in Nevada and please mail the check to the person in Nevada, South Dakota has no jurisdiction over that. The other one would be a transfer agent. So I buy the stock, I'm in Nevada, and the guy I bought the stock from says, Dean, my transfer agents in Colorado, they'll be sending you the shares from Colorado. Colorado has no jurisdiction over that. So it's not where the transfer agent of the bank's located. It's where the offer originated, was directed, or accepted. What Warren Buffett uses fundamental analysis for the valuation of securities and has performance that has better than the market. So, strong form says that Mr. Buffett can't exist. Strong form says Mr. Buffett cannot exist. Weak form says, well, yeah, there are guys like Mr. Buffett using, fundamental analysis who can find perhaps different facts and interpretations. And so that would be weak form. Remember, semi-strong is the idea that inside information works. Your customer believes efficient market hypothesis is strongest form. What would be most suitable? Or that means he doesn't want to spend the money, try to beat the market because he doesn't think you can. All the following are true of criminal penalties on the Uniform Securities Act, except, the right of rescission is civil, not criminal. Criminal means, the criminal part is the part about going to jail, right? Yep. maybe you want to get rid of the accepted. Maybe, going to make this a poor man's flashcard. Fee charges by a broker dealer must notify customers. Now, we're not talking fee for investment advice. We're talking about like mailing you confirms, wiring money, that kind of thing. And we have to give you 30 days notice, because if it's a deal breaker for you, maybe you say, Dean, I'm out of here. Misuse of professional designations. Underneath your card, you could spell out investment advisor representative, but that's not a title like CFP or something. So, you can't misuse that. P.S. You can't use those other ones either if you don't have them, right? So very much a test issue, misuse of professional designations. Very much a test question. I can't imagine any draw in which you don't get asked this. A recession can best be described as 2 consecutive counter quarters of declining GDP. I like Will Rogers' definition. Will Rogers said a recession is when your neighbor's out of work, a depression is when yours out of work. They were asking economists during the pandemic, did they think this was going to be as bad as the depression? And they said, we don't think so. The depression would be 6 calendar quarters of declining GDP. This is high risk, high probability. I can't imagine you're not going to get asked that. Which of the following are prohibited in the investment advisory contract? This is, again, very testable. It comes from debrief. People say, Dean, what's a hedge clause? A hedge clause is where I tell you in the investment advisory contract that I may not be, or I may be in violation of the ethical practices of the Uniform Securities Act. And that if I am, you will not hold me accountable. Stuff like that. A hedge clause is where I'm trying to put some legalese in there that says, you can't sue me. Or I'll say something like a hedge clause would be, even though the Investment Advisory Act of 1940 stipulates investment advisory contracts cannot be assigned without written permission, you waive your written permission and allow me to assignment of your investment advisory contract. No. So hedge clause is any legalese that is not allowed. So anything that parts, right? So a hedge, that's what that word means, as it relates to legalese, a hedge clause. Which of the following describes the firm? That would be 2A. Cash transactions over how much trigger a CTR? Again, a lot of people tell me they see this. Remember, the 5 is the SAR. This is the CTR, and that's the SAR. That's suspicious activity report. If there are material changes to the brochure since the last annual update, how many days from year end do you have to deliver that? 120 days. Contents of the solicitor's brochure include the name of the solicitor, the broker-dealer, yep. The name of the federally covered investment advisor, yep. The nature of the relationship between the solicitor and the investment advisor, yep. And compensation, where it's going to cost you more. I used to tell people, listen, the investment advisor I'm soliciting for has a 2% asset under management fee, and they're going to pay me that first year's 2% for getting you involved with them. And you would have paid that regardless, or you got to pay me an extra 1% to access that investment advisor. Again, you got to be able to do this. So quarterly dividend of 20 cents is going to be 80 cents. Current yield is always what an investment pays you divided by what it costs you. And so I'm going to take 80 cents. I'm going to divide by 20, and I find out that's 4%. So don't be giving up questions like that. All the following are accredited investors. Again, this is a debrief. This is high probability. This has been showing up a lot. It makes sense to me because NASA's probably getting tired of people thinking they take their 65 and they're accredited. That's not true. The SEC expanded this definition of accredited investor, but when they expanded it to include 7s and 65s, they said, in good standing with FINRA or state laws, right? So a natural person with net worth of $1 million, yes. Natural person with 200, yes. C, yes. And then here we go. A series not in good standing or without an active registration. Again, that's been showing up quite a bit on the exam. No. You folks are taking your 65 now without being affiliated with an investment advisory firm. You are not an accredited investor. Unless you meet these other standards here, right? Which of the following bond portfolios is for a rising interest rate environment. That would be ladders, right? As the bonds mature, we reinvest at whatever today's rate is. Which of the following, again, this is testable, are money laundering red flags. Red flags is the terminology, right? It's a red flag that your transactions are not commercially illogical. It's a red flag about the source of the funds. What I mean by that is maybe, I'm not quite sure where they came from. Cross-border transactions, particularly if it's from, I hate to sound prejudicial, but, let's just say it this way, locations that are noted for being, destinations for money launderers. Avoidance of triggering the CTR. So I say, listen, you need to go give me a cashier's check for 21 grand. I don't accept personal checks. I don't want cash. I need a cashier's check. And then you say, Dean, if I give you a cashier's check, you can file a CTR. I said, well, of course, it's more than 10. And so then you come back with 3 cashier's checks for 7. That's called structuring. And it looks like you're trying to avoid triggering the CTR. And so, yes, that would be a red flag as well. We talked about the solicitor. You can expect a couple questions on the solicitor. The solicitor's disclosure brochure and agreement must include which of the following must include. Let me fix that. That should say, I think the better grammar here would be all of the following. All the following except. So we're looking like something that doesn't need to be in there. The agreement between the investment advisor and the third party solicitor must be in written form. Indeed. A statement that solicitor is being paid by the investment advisor. That's important for you to know because that means I don't represent you. I represent the investment advisor. The additional amount of the investment fee that will be charged if the third party. Yep. D, the solicitor's brochure describes the nature between the solicitor and the investment advisor. If I put all the disclosures, I can have one brochure. No, it's got to be two separate brochures. Trust, you're going to get a couple questions on trust. And, here's a good one, right? There's my version of a good trust question. Why would you want to set up a trust? For estate planning? Yes. Avoid probate? Yes. Lower the estate taxes? Yes. Less paperwork? No. I mean, trusts are more complicated than a will. And so the answer there is D. That's not an advantage of a trust. That's a disadvantage of a trust. Generate additional income. We said when you want income, you're going to sell the option. This is called a covered call. You're agreeing to sell stock you actually own. So that's called a covered call. And again, I'll just let you decide as a 65 how much you want to put into options to pass your exam. What is the difference between a Class A and a Class B shares? Class A shares are no loading. By the way, once you get to some part of a sentence is false, the entire statement is false. So that's why Dean just went and stop reading, because once I get something that's false, that means the whole thing is false. False. Class B shares are no load and Class A shares are not. Class A shares have a contingent deferred sales charge. And Class A shares charge upfront sales charge, and Class B, that is our best answer. That's our best answer, right? So, boom. You do get asked about the difference in the share classes. So, not a big, it's not a, there's mutual funds are testable. Most people get where they're going without financial crashing and burning with an investment vehicle called a mutual fund, professional management, diversification, ease of ownership. Make sure you got a handle on mutual funds. Also, make sure you can distinguish between closed-end funds and open-end funds, because that's huge on your exam as well. Partnership interest in the investment advisor that changes control. So a minority partner retiring transfers partnership interest to a new partner. So minority, new, minority, no change in control. B, minority partner transfer the partnership interest to their living trust. Again, no change in control. A minority party with a 31% interest acquires 20 and 30, that's 51. That means a change in the control. And that would mean, again, that is one of those things that triggers, updating, and then remember transferring assignment and all that stuff we've talked about. All the following are associated with fiscal policy except government spending, yes. Government taxation, yes. Congress and the president who are in charge of fiscal policy, indeed. So fiscal policy is government spending and taxation. Who's in charge of it? Congress and the president. And we have a guy named Lord John Maynard Keynes who came up with what we call demand side economics, saying that when the economy is weak, to equal out the business cycle, maybe the government should step on the accelerator called government spending to stimulate demand. Right? Federal Reserve Board, no, the Federal Reserve Board is in charge of monetary policy. Again, I have some very good lectures for you on those topics. There should be no reason for you to drop any points on economics. 12B1 fees, again, here's the same one again. Again, based on debrief, it's the investment advisory fees. No, it's promotional expenses. All the following are true of letter of intents except they're good for 13 months. Yep. They can be backdated 90 days. Yep. With a letter of intent, you get the reduced sales charge with your initial investment. Yep. With a letter of intent, the investors get the reduced sales charge or when they cross from fund to fund. No. Right. So this is except that's not true. You get it on the reduced sales charge upfront and all your subsequent investments. D is more like rights of accumulation. Client dies and leaves the IRA to relatives. All the following are true, except a copy of the death certificate is required. Yep. Notification is made to the broker-dealer. Yep. Reference to the designated beneficiary form. The reason I put this question in the deck is somebody told me they saw this thing. And so this is my version of trying to come up with a situation in which I'm not quite sure how close to, the exam I've got this thing, but that's why it's here, is because somebody says they had a reference to this thing, and I'm trying to come up with that. If the account was transferred on death, no paperwork is necessary, and that's not true. So the answer is D. What can create a tracking error? Again, this is my version of debrief and coming up with what I think can cause a tracking error. The investment advisory fee, yeah, that's money coming out of the portfolio. So that means it may cause us not to track the index correctly. Lending our securities and collecting money in. Having too much cash not invested. Yep. Rebalancing, all of those. So, customer says, well, Dean, I bought an index fund. It didn't match the index. What caused that tracking error? And here's our some potential reasons for that. Which along is best metric for a mutual fund manager's return? He's got a lot of money coming in out of the portfolio. He shouldn't be held accountable for all that money coming in out of the portfolio. So time weighted return for a mutual fund. If it's an individual account where I'm managing, like I'm an investment advisor representative, and it's the doctor's portfolio, then dollar weighted would be appropriate. An investment advisor rep is named trustee of the client's estate. All the following is true, except this is now considered custody of the client's monies and securities. This causes no change in custody. The client is known as the grantor. The trustee is a fiduciary to the estate. Yeah, no, that's not considered custody, right? So by the way, A and B are kind of different. And again, I don't know how close I am to this, but here's my best shot at it. All the following on 3C1 and 3C7 for a private fund. That's a hedge fund, private equity fund, venture capital fund. They must have 100 or fewer investors for 3C1. Yep. Investors must be accredited. Yes. For a 3C7, who cares about this? Well, I'll tell you what the test question is. There's a qualified investor, which is 5 million. And D is the answer here. The funds don't register with the SEC. The investment advisor does. So in these venture capital, private equity funds, hedge funds that are organized under 3C1 or 3C7, that's what all this is about, is hedge funds, venture capital funds, private equity funds. These private funds must register the fund with the SEC, and they do not. They register as federally covered investment advisors to those funds. So the answer here is D. Again, this is from debrief. I think it's kind of crazy, but assets book value is its purchase price minus the depreciation. A technical analyst would look at all the following. Which of the following? Boom. Right, we'd be using charts. A, B, and C would be a fundamental analysis, a fundamental analyst. Which of the what are the employer's requirements in administrating all of what are the employer's requirements? I'll leave it. A chance for the employees to change the asset allocation quarterly. Yep. 3 investment choices for the employees. Yep. One of the investment choices must be the employer's stock. And no, that could or could not be. That's, just depends. Employees are immediately invested on their own. Yeah, that means the money they put in there out of their check is always going to be theirs. The part that may not be immediately vested is the match. An investment advisor uses third-party research. All the following are true except. The use of third-party research as a basis of recommendation need not be disclosed. That's true. I don't have to tell you how I'm coming up with what informs my recommendation. B, the use of third-party research, if distributed to clients, must be attributed and disclosed. Yes. So if I'm going to send you a value line report, I can't strip value line, put Dean on there, make it sound like I did all this homework. No, that's true. The investment advisory firm can claim extensive research capability based on the number of subscriptions to third-party research. That's what the violation is. Soft dollars can be used to pay for research. Absolutely. So the answer there is C. Protect. Anytime you hear protect, it's going to be long. And what you want to have is a choice to sell the stock and long put. So you're going to marry a put to your stock. Which of the following is the inside market? That would be the highest bid and the lowest ask of all the market makers. And then the difference between that would be called the spread. And, that's the difference between buying and selling, either based on the individual market maker spread or the spread on the inside market. A firm fails to honor its own written supervisory procedures. The firm cannot be held accountable for not meeting its internal house requirements. Oh, no, you most certainly can. The firm can be held accountable by the regulatory authorities for not meeting its own house requirements as spelled out. Yep. As long as its employees have signed an attestation that they've read it and understood it, the firm cannot be deemed to have failed to train. That's false. Written supervisory procedures need not cover cybersecurity and social media. Nope. So B. All the following are true except. So again, we're talking private funds means private equity funds, venture capital funds, hedge funds. All the following are true. The funds are federally covered. The funds are exempt from registration with the SEC. The funds are exempt from registration. Looks like a typo there. Let's fix that. The investment advisor is never required to register under the Investment Advisor Act of 1940. So all the following are true except. The funds are federally covered because, yes, they're offered under Reg D. They are private placements. And private placements are federally covered, Reg D. Therefore, the funds are exempt from registration with the SEC. That too is true. The funds are exempt from registration on the Uniform Securities Act. Remember, that's true because Reg D private placements are exempt from registration under both 33 and the Uniform Securities Act. That's true. The investment advisor is never, no, we just said the investment advisor typically does register as a federally covered investment advisor. The answer is D. Unit investment trusts have all the following characteristics except they are subject to the Uniform Securities Act. They certainly are, or the Investment Company Act. Yes. Remember, you have to classify yourself as either a face amount certificate company, an open-end or closed-end fund, or a UIT. The assets are professionally selected. True. They have passive management. True. No, you can't buy new issues on margin. And a UIT would be considered a new issue. It's considered a new issue 30 days from the effective date. And so you can't buy it on margin. ETFs you can, not a UIT, not a UIT. I don't know if this is correct. I had people tell me they see unit investment trusts. And so this is my best shot at a UIT question. When a BD trades from its own account, these transactions are known as very testable principal trades. Brokers, we all call broker dealers, but in any one transaction, brokers act as agents for commissions. Brokers act as agents for commissions. Dealers act as principals for profits. It's very testable that we always disclose capacity. We always disclose capacity, whether we acted in our agency capacity or a dealer capacity. I say, when you open an account with me at Goldman Sachs is a broker dealer. In some transactions, Goldman Sachs will be acting in its broker agency capacity on your behalf. We're going to get the security elsewhere, and we're going to charge you a commission. Now, in other transactions you do with us at Goldman, we'll be trading from inventory. We're going to be charging you a markup or a markdown. And each and every transaction you do with us at Goldman Sachs will tell you in what capacity the firm is acting. And would never be a broker and a dealer in the same trade. Which of the following is non-issuer transaction? So non-issuer means secondary transaction. It means the previous owner is receiving the money. Issuer transaction means the issuer is receiving the money. So a company sells shares in IPO. Yep, issuer company is receiving the money. Mutual fund selling a Class A share. Yep, primary mutual fund is receiving the money. Mutual fund selling securities from its portfolio. No, that is a secondary transaction, and that's what this is asking. Non-issue means secondary. And when the portfolio manager of the mutual fund sells securities, that's going to be a secondary transaction. A private fund selling partnerships and interests? No. All the following are true of accredited investors, except they can be either natural or unnatural persons. They must meet certain criteria. True. They can purchase private placements. True. The definition of the federal one, not a state one. Be careful on that. So, just because the doctor is an accredited investor doesn't mean he doesn't have the protections of the state administrator of the Uniform Securities Act. All that means is you can accept an invitation to participate in a private placement. It means nothing more than that to say you're accredited. And this is the one that's false, right? Accredited investors are going to be natural, living, breathing human beings. So it's not a unnatural person that meets the stuff we just discussed. All the following are mandatory in a margin account except the loan consent form. All accounts have a new account form. Credit agreement tells you that you're borrowing money from the brokerage firm and you're paying interest based on broker call. That's what banks charge brokerage firms for money. And then the hypothecation agreement says that you understand you're pledging your securities as collateral for the loan. And that means the securities were going to be held in street name. And we say, hey, listen, we have other customers who wish to go short. Would it be okay if we lend them your securities? And you say, well, Dean, I don't think it's in my best interest to lend my securities to people who want to go short. I say it's not, and that's why this part of the document is voluntary. All the following are true closed-end funds, except they can have a higher pop than the NAV. That's true. Unlike an open-end funds cannot issue preferred stock and bonds. They can own them, but they can't issue them. Closed-end funds can. Must allow meet redemption requests. No, they don't meet redemption requests. I don't like my language there. Let me take care of that. I told you, you're going to get questions on the distinction between closed-end and open-end funds. And closed-end funds do not meet redemption requests. They trade supply and demand. So if you're unhappy with a closed-end fund, you simply sell your shares to someone else for more than you originally paid. That's very testable. You could get 3 or 4 questions on that. Dollar cost averaging, very testable. What makes it work? Fixed dollars invested regularly. That's true. It results in a lower average cost because, you're doing exactly what you should be doing, which is buying more shares when they're low and less shares when they're high. And the end result will be you will have a lower average cost than those of the underlying shares. It guarantees a profit. Boy, there are 2 nasty words you never use in the securities industry. You never use the word guarantee and you never use the word approve. Those are just 2 nasty words. So the minute you see that word, you can say, oh, no. When selling shares using dollar cost averaging, you have choice. You can do share identification. You can do last in, first out. You can do average cost. Now, if you didn't keep good records, the IRS will impose upon you FIFO, but that's a separate issue. So the answer there is C. An agent's registration is still pending. So people tell me they encounter a question about your registration's pending, right? So you pass your exam. Let's be clear. You pass your 65, your registration is still pending. Kind of a trick. You're not an investment advisor representative when you hit the button and you pass. That's not. Your registration is still pending. So what can't you do while your registration is pending? You begin sales efforts by contacting potential customers to inform them of his or her pending effective date. So you say, hey, I passed my test and just waiting on the state administrator, but let's get busy. Right? The agent can't do, which that sounds pretty like a problem. I send to the mailroom and you help stuff envelopes with prospectuses. That sounds administrative. Complete administrative drafts requested by the firm. Yep. Fill in for the receptions by answer phone. Yep. So A is what you're not supposed to do. Now, but I don't know. Again, this is just Dean coming over with what I think a question might look like about a pending registration. Debrief, pending registration, Dean's attempt on a question about it. UTMA's 2, 3, 4 questions on UTMA's. So Uniform Transfer Minors Act, the tax ID, definitely testable, needs to go know that, goes on the account. You must be a cash account. You should definitely know no margin. You should definitely know one custodian, one minor per account. All of that is true. We do not need additional documentation. We can use our normal everyday new account form to get this done. Which of the following interest rate changes the most often? Again, there would be no reason for you to miss any of these types of questions because I've told you there's plenty of resources on the channel for you. I think it's more important as an answer set than the particular answer to this question. You know, the discount rate is set directly by the Fed. Fed funds as banks with excess reserves, lending to banks with deficient reserves, and it's the most volatile of the rates. This is the question we got here. Broker call, remember, is banks to broker terms, financing margin accounts. Prime is what banks charge people who don't need to borrow money. I'm joking. Prime rate is banks to its best commercial customers. This is what Apple pays to borrow money. Google pays to borrow money, those kind of things. Why is an investor's experience important? It helps determine their investment objectives. It helps determine their investment goals. Yeah, I think it tells me a little bit about their risk tolerance would be my best answer here, best in this answer set. Again, somebody just told me that, again, this is Dean's attempt on why would an investor's experience be important, and here's my version of this. If you're new, I'm probably going to be a little gentler with you in terms of volatility and risk than if you're somebody who tells me you're an experienced kind of person, you've traded options, for example, whatever the case may be. What asset must an agent disclose to the BD? Again, one of these things is not like the other. It'd be hard for any shenanigans to be going on with your mutual funds you own. It'd be hard for any shenanigans. You're the agent, by the way. You're not, an agent. You're an agent of the investment broker dealer, right? So you're an associated person. Now that may be not true. There's some 65s that are just fee-based investment advisors, but there's quite a few 663s getting a 5, 65, 763s getting a 65. And in those cases, remember, you're going to be both an agent of the broker dealer and an agent or an investment advisor representative, so to speak. Anyways, partnership interest where you're a limited partner, probably no shenanigans, but on over-the-counter stock, maybe you're involved in a way that could be a problem. So it's a D. What best describes a firm's net worth? Yeah, A sounds pretty good. That's that 10 grand, 35 grand, right? Assets minus liabilities equals net worth. I'm hoping to get sucker somebody on B because that's a different thing. I got that. That's a good distractor because that's what, that's about broker dealers and net capital. So maybe I'll sucker somebody who's got a 24, 27 into picking a wrong answer here. A is the right answer. Yeah, the number one use of a stop order is to stop losses. That's why we call them stop losses, but we also use them to protect profits. We also use them to establish a stock position. So we don't use it for D. D is what we call a limit order. Now, again, 65 is a choice for you to make. It is a matter of time. I do have types of orders in the 65 playlist. And there would be no reason for you if you're 65. I think 65, I kind of consider baby seven. If you're coming to 65 as a tabula rasa, a blank slate, and you've got no investment background, you're going to have to lay a lot of base. And so, and the challenge is that it's a base that you got to lay with twosies and threesies. It's not like there's a whole bunch of questions on things. You got to, pick up 1 and 2 here, 1 and 2 here, 3 and 4 there on the test specifications. But I have a whole lecture, an hour plus, on market orders, limit orders, stop orders. That is in the playlist. I think it's sufficient for 65. I highly recommend it. I know you're not surprised. Here's the other version I warned you about. So here, the mom did not die. The mom actually gave it to her daughter. At the time of the gift, it doesn't matter what at the time of the gift. There's no step up here. The daughter is just going to assume the mom's cost base. So make sure, when you read the question, is it a gift or did somebody die? When accepting an order from a third party, which of the following is true? It requires written authorization. Yes. Oral authorization is permitted if it's from a trusted contact person. Absolutely not. Requires supervisory approval. Yes. Third party authorization is never acceptable. So when accepting, it requires supervisory approval on the account, but not the order, right? So the account itself would require that. But the particular order, it's A. Which of the following is true? A firm may commingle customers' monies and securities. So if I'm a large investment, now be careful, this is where, Dean's practical experience, I'm sure there's going to be somebody who disagrees with Dean here, some other, person trying to help you. And it's a challenge to have different voices in your head on all this stuff. But, if I'm a large investment advisory firm, I can have one bank account where I keep all of my customers' monies and securities. And then I would have separate subledgers, but it's one account where I keep all the customers' monies and securities. And that would be okay. A firm must segregate its customers' monies and securities. Now, people might disagree with Dean what I'm saying here. I'm not wrong, by the way. I'm just telling you that this is different. That's okay. Which of the following is true? A firm must. It's not a must. It'd be better practices if people did that. What I'm getting at in this question, again, this is based on a debrief, is what we would not be allowed to do. So, maybe I can tweak this question to make it easier for folks. That's not really Dean's goal in these explications. A firm may commingle the firm's money and securities with that of its customers. Never. Whose securities are those? You need to know whose securities they are. Almost always. That's what happens, right? Bernie Madoff has $1 billion account at JP Morgan, and JP Morgan thinks it's his and not his customers. That's a big, big no-no. A firm may commingle. Never. Let me clear that up. I almost missed a question here because this is a big never. Which of the following is true? A firm does not need to segregate its monies and securities from the customer. So we're looking for it's true. And what's true is this one, right? That's false, and that's false. Wow. Wrote a question that's so difficult, I can't even answer it. But what I'm trying to get at is there's never a circumstance. This is what I was trying to get at in this question, is this idea that we cannot commingle broker-dealers' monies and securities or investment advisories' monies and securities. All the following monetary policy, yes. The reserve requirement. The Fed tells banks how much they have to have on reserve to meet their everyday demand for banking. That changes very rarely. Open market operations, they conduct all the time. Right now, they're buying $120 billion worth of government securities each month. When they do that, that causes buy securities, means the money supply goes up, more money available, interest rates should go down. I would know the effect of buying and selling securities by the Open Market Committee of the Fed, the FOMC. Again, there's no need for you to miss any of those questions. Discount rate is the Fed to member banks. Government spending and taxation, and that's fiscal policy. Looks like, again, I appreciate your patience here, even though I go over these things quite a bit before I try and publish them. Invariably, I'm always finding something as we go along. So the answer here is D. Okay, well, I hope you find these explications helpful. And what we will be doing as we collect more derivatives, putting more of them out there. Make sure you like, you subscribe, you share the channel with any persons who need some help on their exams. I will be posting this shortly. You can always timestamps take me a little while because I got to watch it and I got to timestamp it. So timestamps will be pending, but if you have a question or comment, if Dean has a brain fart and I mess something up, just send that to me. And I'm more than happy to address that in those timestamps. You can say Dean at 2113. And if you note on the bottom of the slide, there's also a little number in the right-hand corner. You can do it that way as well. Okay, so bon chance, mon ami. Wish you good luck on your exam. And 65, the next thing that will be in the 65 playlist will be the conclusion of the explication of the test specifications. I've got, be patient. I got an SIE practice exam I got to do. I got to put up some 9, 10, 24 stuff. So it'll be a while before I finish that up.